Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax updates to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in PwC's Policy on Demand studio in Washington, D.C., where I'm excited to have Rebecca Lee back on the podcast. Rebecca is a principal in PwC's Washington National Tax Services practice, where she focuses on complex tax problems in the financial transactions and digital asset space. Rebecca, welcome back to the podcast.
Hey, Doug, nice to be here.
So Rebecca, it's been almost 6 months since you were last on the podcast. I think this is your 7th visit, but I've lost count and I didn't have the will to run through the 157 prior episodes to add them up. But what's been new in your life for the last 6 months?
Well, the last 4 months or so, we have a puppy.
Wow.
Right? So his name is Cookie.
Okay.
He is a 4.5-month-old chocolate lab.
So you got him as a tiny little.
Like a little bit. So we got him, we took him home when he was 8 weeks old, but we went to visit him at the breeder. It was lovely. But when we picked a name, we hadn't really gotten to know him yet. And so we were picking between Cerberus and Cookie. And my son decided Cookie was his name after meeting him. We should have gone with Cerberus. So we call him Cookie King of Demons.
Okay.
He's at that puppy stage where he bites everything. So he's like a little fur piranha.
Does he have a middle name? I mean, could it be Cookie Cerberus?
It could be. But I think for right now, we're letting everything kind of his personality settle in before we finally we add anything to the whole Cookie thing.
Love it. Well, I'm a big dog person. Puppies are challenging, but once they're potty trained, I would encourage you to think about a middle name. We adopted our dog, and his name is Rich Dewar McHoney. The middle name named after the family that we adopted him from.
Oh, see,
which also is a consistent guest here on the Cross-Border Tax Talks podcast from the Dewar family. Yeah.
So, not that we're bragging, but our older dog is named Carbon. His full name is We Are All Made of Star Stuff.
I see.
Lovely, right?
Yeah, that's a lot to put on.
Indeed.
Yeah. All right. So let's move to more exciting topics than puppies. Digital asset regs. So the IRS issued final regulations for reporting digital assets, TD 10,000, which has to be the coolest number of any Treasury decision, right? 10,000. All right. So it provides guidance on information reporting and the determination of amount realized and basis for certain digital asset sales and exchanges. Before we get into the details, what did these regulations broadly cover, and why did the original proposed regs garner, according to the IRS, 44,000 comments?
And 127,000-ish if you go by the number on the Federal Register website.
Wow.
Not all of which were substantive comments, but so this is really revolutionary stuff. When the proposed regulations came out, they were the first really comprehensive package to provide holistic guidance for the reporting of gross proceeds and basis and transfer information on digital assets. And so a lot of what they had to do was define what a digital asset is, how it's reported, who's subject to reporting, what information has to be reported. And for an asset class that historically has had, depending on where you invested, a different level of income tax reporting, where there's required disclosure on the 1040, on the 1065, and other forms, the information related to what gets reported when, by who, and how is unbelievably important in an industry that has technology that's evolving every day. So these were objectively a really big deal. And I think the degree of which you see taxpayer participation in the comment process is really representative of how important they are.
Yeah, just, I mean, staggering. Even 44,000, let alone 127. So I guess 44 are maybe the substantive comments. So what was in the package? Because I know there were final regs, but there was a couple notices, a revenue procedure. I mean, just a lot here, Rebecca, for us tax professionals.
And you have to picture right before the 4th of July break.
Of course.
Yeah.
Of course.
We were on the phone with a client discussing digital assets when they came out. It was the greatest moment.
Yeah.
So we have final regulations, so TD 10,000, which has regulations on broker reporting, on the basis information that needs to be retained and sort of tracked by taxpayers, information related to who is required to report, backup withholding information, which is where if you're a U.S. person and your data or your tax ID number is incomplete or you're otherwise subject to backup withholding, you can have proceeds withheld upon, and a host of other topics. So that's the regs, final regulations. Separately, there were 2 notices that provided different kinds of transition relief around the effective date for the provisions that are in the final regulations and solicited some additional comments.
And that is to give taxpayers notice that their future additional regulations will be coming.
To be issued expeditiously.
Yep.
And then there was a separate piece of guidance on reporting of basis, sort of the transition between what happens between now and when the basis regulations become effective.
And that was the revenue procedure?
It is. Yeah. And it's intended to be helpful to allow taxpayers who've been using a variety of different methods to get to a point where they're ready to apply the regs.
Yeah, one of the things that I found interesting, and we'll dive more into this, is that Treasury and the IRS did appear to have some sympathy for taxpayers when it comes to all of this reporting and required fairly generous time frame and transition to get to this reporting, but we'll get into that. So Rebecca, the IRS said in a press statement, and I'm going to read you a quote here, that, quote, "These regulations are an important part of the larger effort on high-income individual tax compliance. We need to make sure digital assets are not used to hide taxable income, and these final regulations will improve detection of non-compliance in the high-risk space of digital assets," close quote. So my question for you is, why are these regulations relevant for companies and corporate taxpayers?
Well, Doug, if you go back to some of my prior podcasts where I talk about this, I'm kidding, but the big deal here is about who is required to report and what information gets reported, because if you picture you are a company that utilizes blockchain technology somewhere in its value chain, in its interaction with customers through a variety of different programs, through accepting payments, the fact of using blockchain could potentially pull you into having to do reporting on the digital asset that is created in that blockchain technology. And that would have had a huge impact on the development of technological solutions that have, in many circumstances, not much to do with like Bitcoin or core, what people think of when they hear digital asset. The other thing is that as we think about payment systems modernization, whether you think of it through the lens of the digital dollar or digitized central bank currencies, whether you think of it as blockchain as an enabler for modernization of kind of banking transactions, there's this whole universe of how can we use technology to ease speed of settlement, certainty, to reduce incidents of fraud. And again, all of those kinds of activities are directly impacted by the per transaction, with in many cases no de minimis amount reporting that's required for brokers of digital assets.
So whether you're accepting payments or making payments in this with digital assets, you need to pay attention to these rules.
I think so, but I think they're worthwhile anyway.
Well, that's why you're here. Okay, so let's start then with, and I would refer our listeners to some of our prior podcasts, although...
It's shameless, I'm so sorry.
But we do cover a lot of kind of some of the background on what is a digital, on the various types of digital assets. But what is a digital asset as defined by these regulations? And I might try to slow you down on some of these, although, again, I would encourage listeners to check out the prior podcast.
So this was the subject of a lot of commentary.
Sure.
So the question isn't like, what's a digital asset in general? The term is a defined, I mean, this is so cool. The term digital asset is a defined term in the Internal Revenue Code when the Internal Revenue Code was modified to add the digital asset reporting. And it's any representation of value secured through cryptology on a blockchain or similar technology, kind of paraphrasing there. And so a significant number of comments focused on the idea of that's an incredibly broad definition. What are the things that you're really looking to include? And so one prong of the commentary was around the question of what's a representation of value? And the IRS has issued prior notices and other guidance dealing with specific kinds of digital assets, like a non-fungible token or NFT. Is that itself, is the digital asset the value, or is it a representation of value, like another asset that you would look through to?
And an NFT is?
A non-fungible token.
Yep.
It is just an asset with a unique identifier, unique in the world, so it's an N=1, that can be essentially a vessel for just about anything. Digital art.
That's what I commonly think of.
Exactly.
Digital art or digital baseball cards. You know, I'm a baseball
Music,
guy. Okay.
Because you can have your own individual, but you can also use it for financial transactions, for securities. Like picture back when stocks were certificated and they had numbers associated with them. You could similarly have NFTs that replicated that through a technology format.
Sure.
They're really an empty vessel. And what the prior guidance that the IRS had issued was like, we think about the NFT being the container and we look through to the character of the asset within it, which could be a digital file, some kind of intangible or something else. But that's like a subset of what gets covered here, which is it covers your Bitcoins, your Ethereums, your kind of things that are themselves the digital asset. And it covers things where tokenization or a digital wrapper has been put around a real world asset as well.
And what about, what does it not cover? So I understanding, so like cash in digital form. So what does it not cover?
Okay, so what it doesn't cover, this is like the geek in me that loves reading regs was fascinated by how the drafters did this. So what they said was they kept the definition of digital asset really broad, and they said it covers most things. It doesn't cover cash, and in the definition of cash, which is a defined term, is that if you have sort of a digital representation of a fiat currency that's issued by that, essentially that government. So if you have a digital dollar issued by the US government, that is sort of cash, that same, like a right to receive repayment back for $1 a token in all circumstances, issued by a third party, is called a stable coin, not treated as cash, has its own rules. With minor exceptions, the digital asset definition is incredibly broad, but what the government did instead was they said, we're going to come up with a list of sales that are just not going to be reportable sales, so that we're not in a circumstance where we have scaled back the definition of digital asset in a way that we would have liked to keep the definition broad when it gets picked up and used in other code sections, which it has and we expect what might be in the future.
One of the concerns of the many that were raised, I think, in the commentary was with respect to loyalty programs. Tell us about that, because that seemed like a leap, but help explain why that's a concern for taxpayers.
So, and skeptical as you may be, there was a period of time over the last few years where programs used NFTs to create kind of digital loyalty programs. Your card would be digital. You could get essentially airdrops or the equivalent of coupons or other things received in your digital wallet, because the technology, the underlying blockchain technology, and the contractual arrangements you can create within it, which are smart contracts, they're all just programming with particular terms, you can use to do just about anything. And so the concern started to be, if I use blockchain or similar technology, which is a broad umbrella, as the backbone for a digital loyalty program, think, the types of things, whether it's points or other assets, or if I use it as a way of doing giveaways. This was of concern because they're like, this isn't really, they're not sellable. Mm-hmm. There's no platform for them. Like, what is the reporting here? And the record keeping requirement, even if you don't necessarily have transactions to report, is incredibly burdensome. Mm-hmm. And so it was really welcomed relief that they carved out loyalty programs, certain video game or other kind of assets that are created in game or within a family of games, because sometimes you can sell or exchange them with other players. If it's within an environment where you can't sell it outside of the game, those are carved out from being reported. They're still in the definition of digital asset. They're just not the kind of transaction that's going to show up on a 1099 digital asset or 1099 DA form.
Got it. All right, so let's move on to kind of calculating basis, gain, and loss from digital transactions. But remind listeners, because we definitely covered this, the general rule of taxation for cryptocurrencies in the US, and then we'll get into some of the final regs.
Sure. All the things we're talking about are just property from a tax standpoint. So when I sell or exchange them, I'm comparing base case, if it's a realization event, my amount realized versus my adjusted basis in the asset to calculate gain or loss, which then I, as a taxpayer, am required to report on my return.
All right. So then the regs provide a much more detail on how we determine amount realized, generally being how much you're accepting for this particular asset, the basis being how much it costs. So let's start with determining gross proceeds, so that kind of amount realized.
And so this is a place where the regs, I don't want to say expanded the type of information or transactions that are subject to reporting. So if you think about your brokerage account and your securities that you own today, typically speaking, when you get reporting from your broker, the transactions are where a broker has exchanged the security for cash on behalf of the customer.
Right.
And so figuring out amount realized is not tremendously hard because it's like the cash I got. You occasionally see like dividend reinvestments or things like that that might on the margins make it a little bit more challenging. In the digital asset world, they expanded reporting to include digital asset for digital asset exchanges, which invites this whole world of I now have non-cash proceeds that I have to value and then figure out the value that is reported as my amount realized or my gross proceeds to then compare against my basis. And that's where if we toggle between the basis rules that were issued they're for you and me. They're for the taxpayer who has to sit down and do their 1040. They are not necessarily they are equally relevant, but they are not solely for the benefit of the broker who has to report you gross proceeds. So I have an amount realized input into my reporting.
Yep.
And in the future, they'll have to report basis information as well. And so that kind of guidance around the gross proceeds reporting feeds, the goal is from a sort of health of the tax reporting, closing the tax gap kind of sense, is that you'll have reporting on the gross proceeds, you'll have some degree of information reporting in the future on basis, and so the government will have a good sense on information that's reported to them, roughly speaking, of the amount of gain or loss they'd expect to see on your return, noting that in many cases, the basis information reported out may not square with the basis of the actual asset that you sold.
All right, so tell us then about the basis. What information does give us on determining basis?
So, and I'll start with like basics, which are the rules look a lot like the rules applicable to securities. And so they start with your default rule. If you own more than one of the same thing, people refer to those as lots. If I own more than one of the same thing, and you got to tell which one did I sell when I only sell one of them, I can choose to relieve my basis on a first in, first out. That's like the baseline. If I do nothing, that's the default. Or I can specifically identify. And in the world of a custodied wallet or where my assets are held by someone else, like a custodian, I have to tell them which one I'm selling. I want to sell my highest cost. I want to sell my oldest lot. You have to provide them instructions that they implement.
Because all that's identified because of the nature of the blockchain, right? So that those custodians can specifically identify, I guess in theory.
That is the concept. And similarly, the idea is that you have to do that on or before the time that you make the sale. At least that is the rule for securities that they have imported and then finalized in these regs. This is different than, for example, a frequently asked question that the IRS had on their IRS website. I think it was question, let's say 41, might not be right. And in that question, they said, look, if you have assets that are held, you can use any reasonable method so long as you track it, and you can make the determination, for example, for things that are not held in an account, you can make that determination at year end, kind of look at all your lots and relieve basis and make sure you don't duplicate or omit. And one of the challenges there, if we step back and say, how do people hold digital assets? And I'm going to use the brokerage analogy. You can have more than one account. Broker reporting, so what you get from your broker is tied to an account. I can hold multiple accounts, or in the digital assets world, I can hold multiple wallets. And so a big open question that the regs address is that you sort of need to specifically identify, if you're not using first in, first out, on a wallet by wallet basis. The thing that you sold needed to be sold from the wallet that had the basis that you sold it from.
Got it. And then there's also a concept that felt new to me called unused basis.
So this gets to this transition relief that the IRS provided in the revenue procedure. And I mentioned that frequently asked question and maybe some existing tax accounting methods that were out there. If you were treating all of my like-kind assets as part of like one big pool that I was relieving basis from, that was making sure there's no duplication or omission, I can tie it out to real purchase numbers or similar. The IRS gave fairly detailed relief around essentially saying, let's figure out what your unused basis is as of the date these regulations become effective, January 1st, 2025. And that'll be kind of your number. And we're not going to necessarily get into the details of trying to figure out where they tied to looking backwards. We're going to give you, if you fit within the various provisions of the RevProc, some degree of relief. But going forward, you then need to follow the final regs, which tell you by wallet.
And then you got to specifically identify.
Exactly.
Okay. There were also some rules on allocation of digital asset transaction costs. What did those say?
So anytime you sell something, somebody's got to get paid.
Yeah.
And so in the proposed regs, they proposed a 50-50 split. Like if I sell one digital asset for another digital asset, they said, well, what we'll do is we'll take the transaction costs, you'll allocate 50% to your proceeds from the sale, and 50% will get allocated to capitalized into the basis of the asset that you purchased. And that sounds really simple, and to administer, it's actually really challenging. Because you got to take it, you got to split it in half, you got to track it separately. And so the final regulation said when you have transaction costs on an exchange, we will treat them as additional proceeds on the sale.
Okay. Yeah, I mean, anytime you're dealing with transaction costs, particularly in the deals there's just how do you allocate those and the work that needs to be done.
This is a volume exercise.
Oh,
People do hundreds of millions of transactions. And so the idea of something that sounds easy for like one transaction in an Excel is just really hard to make programmatic.
I can imagine. Okay. And then finally, with respect to the calculating kind of basis gain and loss, there are also some ordering rules.
Yeah, so they're trying to get at this, I don't want to say problem, but this challenge of I'm going to, in the new world, so picture it's this time next year. And of course, I've got my, crypto millions that I'm sitting on. Kidding. And I have to figure out, did I sell from my new wallet or my pool of unused basis, and how do I sort of figure out when they're all sitting in the same wallet going forward? I have units that I purchased after 1/1, I have units I purchased before. So the revenue procedure gives some instruction on how to differentiate and calculate basis for those kind of transition assets.
Got it. So moving on to the reporting requirements, and there is a ton here in the reporting requirements. Any key takeaways for listeners on the reporting requirements? I know, for example, there were specific rules for custodial brokers, but what are some of the key takeaways? Because there's a lot there.
There's a lot. The biggest, first, I'd say chunk, and this is a great illustration of the IRS and Treasury really considering comments provided by the industry and trying to come up with things that really are able to be implemented. They segmented the world into custodial wallets. That's where I hold your private keys. I control dispositions and sales as a service provider for you. And those kinds of custodial relationships, the rules have an earlier effective date. The idea is that the broker has real transparency over the relationship. They have a contract with the customer. They have the ability to gather all the information and do the reporting with appropriately phased effective dates. There are a host of participants in digital asset transactions. The whole goal of blockchain is it is a decentralized ledger, which enables all sorts of participation through decentralized mechanisms. And so the proposed regulations had a very broad definition of who's a broker, which included this concept of a facilitative service, which are these things that can assist buyers and sellers connecting in the market, or can assist in a third party being able to exchange one thing for another through the use of blockchain technology. the drafters concede that being able to write rules that are able to be administrable for those areas can be challenging. They solicited additional comments and they reserved on sections of the regulation for future study. And so this distinction between do I have a custodial relationship or not today ends up being a big driver between do I have current reporting obligations or potential future reporting obligations.
And can you give like an example or an analogy of that?
I was wrestling with this question with a client, and we were trying to figure out the best way to phrase it. And what came to me was like, let's say I park in a garage. So like this morning I drove into the office, I parked downstairs. Once I park, I can give my keys to the valet. At that point, the valet can move my car anywhere they want, subject to the contract that I have with them, that they're holding my assets. That's a custodial relationship. Mm-hmm. They have the keys, they can do whatever they want. Similarly, I could go and I can park. I take my keys with me. The garage is holding my car, but the company that runs it or the valet standing there doesn't have custody of my car. They can't move my car. They can't do anything with it. And at that point, you say, that's clearly non-custodial. And then in the middle is this fact pattern of what happens if the garage closes at 10 p.m. and I can't get my car. So they can't move my car. They don't have the keys, but I can't move my car because it's immobilized. And that's sort of in this middle ground of it doesn't feel custodial, but does the fact that someone else can deprive me of the ability to use my keys to dispose of the asset make it something more than non-custodial?
Got it. I love that. That analogy is very helpful. So the form that is required is Form 1099 DA, digital asset. Talk a little bit about that and what changes or what's important for listeners to understand with respect to the form that is going to be required.
So this is where all this information reporting lands. There was a draft form published under the proposed regulations, which listed all the data fields. And one of the great things about the regulations package is they did skinny down the data fields that need to be reported on that form on a per transaction basis. So things like they took out the timestamp, which would have hour, minute, second on which the sale occurred. They took out some of the alphanumeric code associated with each of the tokens. So there were things that they did to simplify the reporting or the number of data fields. And we expect they'll publish an updated form that will reflect the updates to these fields. It looks and feels a little bit like the form, the 1099B that you get for securities, but just reflecting all the fields that are very specific to digital assets.
Got it. So there are a number of examples in the regs and accompanying notices to help taxpayers transition for compliance. One of those was Notice 2024-56 that provides some transition relief. One's Notice 2024-57 providing some temporary exclusions. What are some of the important things with respect to those transition rules?
So they do, I would say, two things in large strokes. The first is they provide a good faith standard for the first year of compliance. Essentially, it's going to be the first year. This is very similar to what the IRS and Treasury have done with other information reporting packages. You make a good faith effort to comply. Your good faith effort to comply is going to kind of satisfy your obligations for the first year. The exclusions in the other notice are really around transactions where you are otherwise a broker and you have reporting obligations today. Types of transactions, whether they are, I'll lump them together and say DeFi, certain wrapping and unwrapping transactions, certain reporting incident to certain kinds of staking activities, not the income reporting piece, just the gain or loss piece of it. They gave some very generous transition and solicitation for more information.
Yeah, and I mean, this feels, and we'll talk a little bit about some of the global stuff, but it's interesting with Pillar 2. I'd be remiss to have a podcast and not mention Pillar 2. The Globe Information Return is not due until 2026. So it's nice that policymakers understand that these new reporting requirements come with transition costs and changes to actually be able to accumulate this information. So it's nice that the IRS and Treasury have provided that. Maybe the last question on these regs, and I know this is maybe an unfair question, when are these rules broadly effective? Because there's a whole suite of different rules and requirements.
There are. Shameless plug, we do have a list of the dates of applicability in the back of our alert that just came out, but big picture, 1/1/25 is the date for transactions affected on or after that date where gross proceeds reporting will apply. And then there are tiered effective dates after that into 26, 27 around other information and transfer statements. But when I think about what the industry has ahead of them between now and the end of the year, that's the first bogey that folks are shooting for, is ensuring they've got enough information to be able to meet the first hurdle.
All right. So kind of moving away from this new this new reg package, what's going on around the world related to taxation of cryptocurrencies? I mean, what are you seeing in other jurisdictions? I know the OECD has provided some guidance, the EU. How does this reg package and the approach that the US is taking compare to what we're seeing around the world?
It feels a little similar to kind of FATCA, Common Reporting Standard, and the Intergovernmental Agreement, in the sense of we have broker reporting regulations that have now, a portion of which are final. The OECD issued the crypto asset reporting framework, as well as proposed changes to the Common Reporting Standard to include kind of institutions that have digital asset accounts and relationships. And the idea of what those packages are doing are intended to be similar, not identical in many respects, to our US rules. And similar to other OECD initiatives, they have to then be enacted on a per country basis, which means the rules can differ by jurisdiction.
Yes.
And on top of that, we have DAC 8, which is its own information reporting regime over digital assets. And so similar
for the EU.
For the EU.
Yeah.
And so you end up with this kind of overlay. If you're a global organization, you have an overlay of navigating the US rules, the whatever gets implemented on a per jurisdiction basis for CARF and the updates to the Common Reporting Standard. You have DAC 8 compliance. And then you also have, if the IRS and Treasury were to get additional guidance, for example, they've asked for legislative updates to FATCA to expand to cover digital assets as well. You have this framework of multiple reporting regimes, each of which request different information on different timeframes in different formats to be provided to different regulators.
Yeah, and even within the EU, it seems that there are differences in how, whether they're considered property transactions, how the gain and how the basis. And so really for multinational organizations that are dealing with these cryptocurrencies, just a lot to process. And I mean, I think it's, again, very similar to what we're seeing with Pillar 2, the OECD provides a common framework. Now, the Pillar 2 is a little different in that there's incentive for companies to have qualifying regimes to all have a common framework or common rule set. But what we're seeing in practice is that there are actual significant, meaningful differences. Here, there's really, within the crypto world, there's not that incentive to have a qualifying regime like that is built within the Pillar 2 architecture. And I think the challenge for taxpayers is they just have to comply with each of these countries' rules as they enact them.
I do think there is an incentive, though, which is the operational side of it. The more the legislation looks quite similar in each jurisdiction, the more a standardized process can be employed so that information can be reported in multiple places in similar ways. And so I think one of the things that ends up being a driver here is it becomes a big change management question, not just from a how do I get from here to there and make sure I'm compliant in all the jurisdictions I operate in, but how do you educate the business, like outside of tax, about what these obligations are? Because a lot of times the tip of the spear here isn't tax building the reporting engine, it's product building the thing they're going to offer in the market and making sure that tax isn't an impediment to being able to develop the new technology or the new offering.
And I assume similar to Pillar 2, to be able to file these forms, there needs to be a process to be able to get the data, which means the tax people are going to have to work with the business people or finance people and create a process to be able to get the data they need to be able to report and ultimately do the calculations.
Unequivocally, and remember, this is a world where the underlying technology or the underlying data, a portion of which is public, albeit anonymous on if it's an on-chain transaction.
Right.
So now you sort of have this world of my data sources aren't just my single source of truth within my organization, but how does that reconcile with publicly available information that the IRS or another regulator could access? Which means you got to be really good friends with like your data team, and you have to be willing to roll up your sleeves and actually understand like the background of where your data comes from and the sources and how reconciliation works, because that as a starting point as a pure data question, but it ends with somebody representing about the accuracy of a tax filing.
Yeah, it's a fascinating point in that the whole point of the blockchain and cryptocurrency is the transparency and the window in. So it really gives taxing authorities that opportunity to be able to audit those historical transactions.
But in many cases, it's a dirty window. You don't get a full view because of not just the anonymity of the transactions, but also oftentimes if I'm working through one or more intermediaries or custodians, the data that's sort of on-chain may not be complete.
Interesting. All right. Well, Rebecca, fascinating as always. Love having you on, and look forward to our next conversation.
Thank you.
Thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Rebecca Lee, a principal in PwC's Washington National Tax Services practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.